Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Integer Holdings Corp. Quarterly Report. Integer Holdings Corporation offers a diverse range of businesses and services across various medical device markets. These include medical devices for interventional cardiology, structural heart, and peripheral vascular procedures, cardiac rhythm management products, such as pacemakers and defibrillators, neuromodulation products, including spinal cord stimulators, orthopedics, minimally invasive surgery, and general surgery devices, portable medical devices, including patient monitoring systems, ventilators, and portable ultrasound machines, medical technologies for various applications. The company serves multinational original equipment manufacturers in the cardiac rhythm management, neuromodulation, orthopedics, vascular, and advanced surgical markets. Integer Holdings Corp. Stock price drop. A year of setbacks. In the past year, Integer Holdings Corp. ITGR has experienced a significant stock price drop of over 43.05%. The primary catalyst for this decline was the company's revised financial guidance and cautious outlook in October 2025. This included lower sales and profit forecasts for 2025 and a conservative preliminary outlook for 2026. Several key factors contributed to this downturn, including slower new product adoption, increased debt, analyst downgrades, and a decline in the portable medical market. The company's electrophysiology products and emerging customer neuromodulation product saw slower than anticipated market adoption rates, creating a headwind to total sales. Additionally, Integer Holdings reported an increase in its total debt by $204 million, contributing to investor caution regarding the company's financial flexibility. Analysts also downgraded the stock from overweight to equal weight, citing limited visibility into the specific products affected by the demand shift. These setbacks collectively led to a dramatic downturn in ITGR stock performance, with shares plummeting over 31% on October 23, 2025, and nearly 42% over the past year. The primary drivers of revenue growth or decline can be summarized as follows. Revenue growth is primarily driven by strategic acquisitions such as Precision Coating LLC, $153.5 million, and VC Paraline, $24 million, which have contributed significantly to the company's revenue increase. Additionally, new product ramps, emerging customers with PMA products, and contributions from recent acquisitions have also boosted revenue growth. On the other hand, revenue decline is primarily attributed to discontinued operations, specifically intersegment sales to Electrocom, as well as increased costs associated with supplier financing arrangements and intangible asset amortization expenses. Furthermore, declines in cost of sales, selling, general and administrative expenses, and research, development, and engineering have also contributed to the revenue decline. Overall, strategic acquisitions and new product ramps have been key drivers of revenue growth, while discontinued operations and increased costs have led to a decline in revenue. Net income experienced fluctuations in the given period. For the 3 months ended, it initially rose by $4,239, but then decreased by $33,858, resulting in a net loss of $54,222. The 9-month period saw a decline of $32,993 from the previous year's figure of $87,193, settling at $54,200. Profit margins also underwent changes. Gross profit margin remained steady at 27% for the 3 months ended, but decreased slightly for the 9 months ended. Operating profit margin declined to 12% in the 3 months ended from 13.5%, while it increased to 12% in the 9 months ended from 11.9%. The reasons behind these changes include significant restructuring and other charges of $6,507,000 for the 9-month period. Additionally, the effective tax rate underwent substantial variations, a decrease to 13.7% for the 3 months ended, but an increase to 31% for the 9 months ended. The company is indeed generating positive operating cash flow, as evident from the financial summary provided. The key indicators that support this conclusion include a net cash provided by operating activities of $140,733 for the 9 months ended September 26, 2025. An operating cash flow (OCF) of $69.9 million for the same period. A total cash generated by operating activities of $140.7 million. These figures collectively demonstrate that the company is producing sufficient cash from its core operations to meet its financial obligations and invest in growth initiatives, thereby confirming a positive operating cash flow. The company's debt level has undergone some changes. Long-term debt increased from $980,153 to $1,193,826, while the current portion of long-term debt decreased from $10,000 to $0. However, it is the interest expenses that have seen significant fluctuations. Interest expense decreased by 35.6% from 2024 to 2025, but debt-related charges included in interest expense increased by a substantial amount. Management's outlook and strategy. The company is poised for strong operating performance driven by cost reduction, efficiency initiatives, and long-term growth investments. Key strategies include operational excellence through process improvements and resource reallocation, selective acquisitions to expand product offerings in key markets, and strategic reorganization to enhance profitability. To drive growth, the company will focus on supply chain efficiencies, strategic acquisitions, and managing debt while optimizing its capital structure. Additionally, management will continuously evaluate business operations to realign resources and transform the organization through restructuring-type activities. Concerns over inventory buildup and supply chain disruption. The financial summary highlights two pressing concerns for the company: inventory buildup and supply chain disruption. On one hand, there is a decrease in overall inventory levels, with inventories decreasing by -12,241, 2025, and -31,515, 2024. However, specific amounts of $5,037,000 and $8,612 have been allocated for inventory buildup, indicating potential issues. Furthermore, the company's raw materials and work-in-process inventories have increased in 2025 compared to 2024. This could lead to inefficiencies and wasted resources if not managed properly. On a more alarming note, there are concerns about supply chain disruption due to global events such as inflationary pressure, elevated interest rates, conflicts between Russia and Ukraine, and Middle East conflicts. Delays in shipments to and from certain countries have also been reported, which could impact the company's ability to meet customer demands. That concludes the financial summary for Integer Holdings Corp. Feel free to comment below, and I will be happy to answer them when possible.